Hello traders, and welcome to my video on the triple top candlestick pattern. So what we're going to do is we're going to look for areas of resistance that have been hit at least 3 times. So if we start with this one here, you can see that this resistance is hit once, twice, 3 times. Hence the triple top. Okay, so that is an example of how easy it is to identify a triple top candlestick pattern on your chart. Okay, there's also double tops, which would be 1, 2 here. It just so happened that this particular example turned into a triple top, even a quadruple top, if that's a thing. But for now, let's just focus on the triple top candlestick pattern. If the price continued down here, it would have been a valid double top candlestick pattern, but we will cover that in another video. So once you've identified the triple top, as we have here, this is a pound-dollar 1 hour chart. You can actually look for these patterns on any particular chart time frame that you prefer. I find that the signals tend to be more reliable on the higher chart timeframes, probably because there's more price data included. For example, you can find triple tops all day long on a 1 minute or 5 minute chart. It's just that they're not going to be as reliable from my experience as triple top candlestick patterns on the higher chart timeframes, 1 hour, 4 hour, daily, etc. That also means less time chart watching as well, which is great. So once you've identified the pattern, the standard way to trade, let's just say the textbook way to trade a triple top pattern, is to find a neckline. Okay, so a neckline is more or less the support within that triple top candlestick pattern, which we can see is this level here. So we've marked that as support, and what we're looking for is price to break through this support level, because we're saying that this is the consolidation zone. Price has rejected this resistance level 3, arguably 4 times, thus telling us this is a strong level of resistance. And when price does eventually move away from it, it will with some force, because the bulls have clearly run out of power. They've tried and tried again. They failed, so now the bears are about to take control. Okay, the main purpose of the neckline here, like I said, just the support level. Following on from this pattern, main purpose of this support level is to time our entry, and the entry is going to be on the breakout of the zone, which you can see is here, and would have actually been a really good trade that we'd still be in now. So here you can wait for the breakout. The good thing about this is you don't necessarily need to be at your charts waiting for the breakout. You could place a pending sell order here, which would get you into the trade without needing to be at your charts. For stop loss, probably I would use the other side of the support level with anticipation that this will become resistance. So let's just say we entered on the breakout here, wait for the candle to close, placed on the opposite side of here, plus a buffer of around 20 pips or so, just so when things like this happen, we don't get taken out prematurely. However, you could also place your stop loss above the previous candle's high, just for extra reassurance and giving the trade more room to breathe. Just watch how this plays out. I mean, there will be times when the price will break out and turn back around and continue up in this direction, known as a fake out, a fake breakout basically, and a stop loss protects us for when that happens. I like to cut my losing trades short and let winning trades run with a good risk to reward ratio to make sure that one bad trade doesn't wipe out loads of winning trades. As you can see, we would have had a really good risk to reward ratio on this trade. I mean, if we took it around here, I mean, the trade's gone over 220 pips with a 20 pip stop loss. That's plenty of opportunity to make substantial amount of pips on that trade. Okay, and what you can do is, well, what I would do is once in this trade and seeing price move downwards, I would then move my stop loss to follow the trade down, so at least to break even. Then as this price fell here, I would use this level of support here and just move the stop loss there, lock in a good amount of profit, perhaps take some off the table, allow the rest of the position to run. I mean, when you see this price action down here, if you were in a trade right from the breakout of the neckline, let me just mark that again. If you had got in after this triple top candlestick pattern breakout here, you might be tempted to take everything there. Once you see that there's some indecision, you can tell from these long wicks there's a battle between the bulls and the bears. See who can gain control of the markets. It starts heading up. Maybe a good sign to exit. We can use other indicators to give us an idea of the strength of the trend. The ADX is a popular indicator for trend trading. Basically, if the red line of the ADX is above the green, it signals that we're in a downtrend. I've added the 20 level here to the ADX. You can do that from the levels. The reason I've added 20 there is because I find that when this main line is above 20, it signifies as momentum in the direction of the trend that is indicated by these other lines here. Markets tend to be ranging as it falls near or below the 20 line. Some traders even trade the crosses of the green and the red lines on the ADX. I prefer just to use it as a filter. And the reason I'm bringing it up on this is because if we were here, we could see that there was a crossover in opposite direction. The momentum of the ADX was falling significantly, so that may have been an indication to exit the trade. However, the main line is still above 20 quite significantly, so had we hung around, we could have maybe squeezed a little bit more out of this particular move all the way down to where we are now, where you see this level of support has formed and is holding quite well at the moment. Okay, so that would have gave you maximum pippage out of that particular move at this moment in time. Who's to say they might break this support level and price might continue falling, but in that instance you could at the moment have, I don't know, your stop loss could be up here somewhere. You could have locked this all in, maybe closed part of your trade around here, and you'd be well up and just seeing how this thing plays out. Okay, so there's many ways you can use or interpret the triple top candlestick pattern. Don't have to do it textbook. I mean, some people may argue once you see this resistance level being rejected 3 times and 4 around here, you could look to enter earlier. I mean, around here somewhere, and put your stop loss on the other side of the resistance level just in case the trend continues. But you can see from the price action, you have a shooting star candlestick pattern there, which is pushing the market down. The resistance is showing price is unlikely to go higher. Just a basic trend line there will show you there's an opportunity. You can even do a breakout trade within the neckline in the triple top pattern. This one here, you see there's support. Look to trade the breakout of this one. As you can see, when it did break through, there was a good bit of movement downwards there. So you would have gotten a bit earlier on this particular move, but this is a strong pattern and very easy to spot on your charts. Triple top, 1, 2, 3. Just make sure you confirm. Well, I'd look to confirm trades with whether that's other indicators, price action analysis, support and resistance, obviously, and have good money management. Okay. Another thing perhaps worth mentioning is that you don't necessarily need to enter on the first breakout here of the neckline. You could have waited for the pullback, price to form a new level of support, and entered on the breakout there. As you can see, there's probably a few people who had an eye on that if you look at how the market fell. That still would have been a good trade. Stop loss could have been up around here somewhere, just above the high there, 20 to 30 pips, and still almost 200 pips down from there. Okay, like I said, it's a 1 hour chart. You can catch some big moves on this time frame with this particular pattern. If you're targeting, say, 10 pips a trade on the 5-minute charts, it's going to take you 20 winning trades to make 200 pips, whereas you can make it on one good trade, such as this one on the 1 hour charts, giving you less time chart watching. You can still have a relatively tight stop, as we've seen, and yeah, just generally more reliable signals from my experience on the longer term chart timeframes. You can also use this particular strategy on any trading instrument, Forex, crypto, stocks, anything you like. Okay, well, hopefully you found something useful in this video. Please like and subscribe for more. Thanks for watching.